In this section, we're going to look at standardized listed options, or SLOs. The option is a contract made between two parties on the delivery of defined assets at a determined price over a specified period of time. According to this contract, the buyer of the option pays for the right, but is not obliged to take possession of the asset. The seller of the option receives money from the buyer for the obligation to grant the assets on demand. In reality, traders do not usually deal with irregular options, but with SLOs. Now, SLOs are options whose trade is standardized by rules of the exchange. Besides SLO buyers and sellers, there is also an Options Clearing Corporation, or OCC, which guarantees the transaction and ensures that it is properly fulfilled. Now, there are two main types of options, calls and puts. Call is an option which grants the buyer the right to purchase assets at a fixed price at any time prior to the expiration date of the contract. A put is an option which grants the buyer the right to sell assets at a fixed price any time prior to the expiration date of the contract. Now, there are 5 factors associated with an option contract: the underlying asset, the multiplier, which determines the size of an option contract, the fixed price of the underlying asset, which is called the exercise or strike price, the expiration date, the date after which the option ceases, and the option price or premium, which varies depending on the supply and demand in the market. Now let's take a look at the first 3 factors. The underlying asset is the subject of the contract, and as such it can be represented in common stock, market indices, or futures contracts. Please note that the strike price of an option is listed as either a dollar amount or a point value. This depends on whether the underlying asset is common stock or a market index, respectively. Now, the multiplier depends on the type of asset. The most popular option contracts are the ones written on common stock or on the market index Standard & Poor 100, symbol OEX. In the fall of 1997, options on the famous market index, the Dow Jones Industrial Index, were also established. The multiplier for all 3 option contracts, common stock, OEX, and Dow Jones, is 100. Now, what does this 100 mean? Well, in the case of common stock, the multiplier 100 means that the purchase of one option contract grants the right to buy, in the case of call options, or sell, in the case of put options, 100 shares of the underlying common stock. Now, knowing the premium of an option and its multiplier, it's possible to determine the total cost of one option contract, as the cost of an option contract equals the premium times the multiplier. Now let's take a look at an example. Let's say we purchase one call option on shares of company XYZ. And let's say that this option has a strike price of $70 and expires in January, and the premium is $4. Given these figures, the cost of one option contract will be determined as follows: 4, the premium, times 100, the multiplier, equaling $400. The purchase of this contract gives us the right to buy 100 shares of XYZ at the price of $70 per share. Now let's take a look at option symbols and how to form them. An option symbol consists of 3 elements: symbol of the underlying asset, symbol of the expiration date, and symbol of the exercise price or strike price. Expiration dates have month codes. They're different for calls and for puts. Also, exercise or strike prices have codes. Now let's take a look at some examples of how to form option symbols. The first is for an IBM January call with a strike price of 90. We form it like this: symbol of the underlying asset, plus the expiration month code, plus the strike price code, giving us our symbol. the next, and S&P 100, December 450 call. Now let's look at a put option. This is for Intel, June 90, put. The last example illustrates how the common stock symbol is occasionally modified for the formation of an option symbol. The symbol for the common stock of Intel Corp is INTC, but Intel options use a different root, INQ. Such modifications usually occur when the common stock symbol has more than 3 characters. Unfortunately, there are no common rules for determining when the modifications occur. However, on almost every internet site connected to the trading of options, there is a retrieval system for the selection of the correct option symbols. Now we're going to look at the premium of an option. It consists of 2 parts: intrinsic value and time value. The intrinsic value of a call option is the difference between the actual market price of the underlying asset and the strike price of the option. The intrinsic value of a put option is the difference between the strike price of the option and the actual market price of the underlying asset. And time value of an option is the difference between the premium and intrinsic value of that option. Now let's take a look at an example. Let's say the shares of XYZ have a market value of $75. We'll look at the premiums on different option contracts expiring in the next month. Remember, options can be classified in 3 ways depending on whether or not there exists intrinsic value. If the intrinsic value of an option is more than 0, the option is considered to be in the money. If the intrinsic value of an option is equal to 0, the option is considered to be at the money. If the option does not have intrinsic value, it is considered to be out of the money. In our example, there are 2 options which are in the money. They are call 70 and put 80. There are also 2 options at the money. These are call 75 and put 75. And the final 2 options are out of the money. Those are call 80 and put 70. The out of the money options, call 80 and put 70, have no intrinsic value. However, they do have time value, and as a result, they're still worth something. Now, how can they still be worth something? This is due to the fact that the options expire in 1 month, and during the course of this time period, market conditions could change in such a way that the options will go in the money, thus creating an intrinsic value. In other words, time value can best be thought of as an expectation that the underlying asset will change favorably. As the expiration date draws closer, the time value built into the option premium decreases. You should notice that the premium on put 70, which is 3/4, is greater than the premium on call 80, which is 1/2, despite the fact that these 2 options are equally out of the money. This occurs because the expectations of investors are that the shares of company XYZ will drop in price rather than increase. Now, market conditions, or the general attitude of investors where there is confidence of a further rise in prices, is called bullish. Market conditions, or the general attitude of investors where there is the belief that the market will drop and prices will fall, is called bearish. There is a relationship between the strike price of an option and the market value of the underlying asset. Time value is the greatest for options when they are at the money. This occurs when the strike price and the market value of the underlying asset are approximately identical. When the difference between the market value of the underlying asset and the strike price of an option becomes greater, the time value decreases. So options which are deep in the money have almost no time value. Therefore, their premiums are comprised of intrinsic value. And the options which are far out of the money have neither time nor intrinsic value. Now, the factors influencing the premium of options are the price of the underlying asset, time to expiration, volatility, and interest rates. The influence of each factor can be described by certain mathematical correlations. The first we'll look at is delta. Delta measures the amount of change in an option's premium price given a $1 change in the underlying asset. Now let's look at an example. Let's say XYZ common stock costs $100 per share. An April call option with a strike price of $100 is sold for $3. While observing the market, we notice that when the price of XYZ stock is increased by $1 per share to $101, our option price increases to $3.50. Thus, for every $1 that the stock price increases, the option price increases by 50 cents. Therefore, the delta of our option is equal to 50%. Now, delta values have the following ranges. Options deeply out of the money have a delta value of 0%. Options that are moderately out of the money have a delta value of 25 to 30%. Options that are at the money have a delta value slightly greater than 50%. Options that are moderately in the money have a delta value of 70 to 80%. And options that are deeply in the money have a delta value of 100%. Our next correlation is gamma. Gamma measures the change of delta given a $1 change in the underlying asset. For example, say an option has a delta of 50% and a gamma of 5%. This means that when the underlying asset increases $1 per share, the delta value of the option increases from 50% to 55%. The next correlation is theta. Theta measures the change in an option's premium in percentage points due to the time factor, the time till expiration, only. Vega measures the change in an option's premium given a 1% increase in volatility of the underlying asset. And volatility is a potential of a stock's price to move significantly up or down in a short period of time. Rho measures the change in an option's premium caused by the effect of the short-term interest rate. Now let's look at the advantages of options as compared to common stock. With the help of put options, it's possible to provide some protection for an investor's common stock portfolio. For example, if the market conditions change in such a way as to cause the stock prices of the investor's common stock to fall, the losses from decrease in the price of the common stock will be compensated by increased value of the put options. The purchase of securities, which compensates for the losses incurred from an undesirable change in the market situation, is called a hedge or hedging. With the help of call options, it is possible to receive a similar profit as that received through common stock, however, utilizing a smaller investment. The method of increasing profit without increasing the amount of investment is called leverage. And finally, the purchase of options limits risk in comparison to the purchase of common stock, as the maximum potential loss is known from the very beginning. This potential loss equals the options premium. Now, the disadvantages of options as compared with common stock. A main disadvantage of options is that they are wasting assets. This means that they only have value during their life. And the holders of call options do not receive the dividends which can be paid to the holders of common stock.